Hello there, everybody. Are you guys all able to see the screen right now? If you jump over, let me get you all over to the screen sharing tab here. Leave a little shout in the chat box if you're able to hear me. Cool. Alrighty. So we'll get started in just a couple of minutes here. Typically, I like to wait just a minute or two so everyone has a chance to get in and catch the presentation from the beginning. And while we're waiting to get into the full swing of it here, I'm just going to talk a little bit about what the presentation is going to be on today. Basically, what we're going to be talking about is the bread and butter trading strategy that we employ here on a daily basis at AlphaShark Trading. We focus a lot on equity options trading, and specifically on trading with institutional order flow and the momentum that institutional order flow creates. So if you guys ever watch CNBC during the day, Fast Money, and some of the other shows, they like to highlight these institutional orders that they see coming from big hedge funds and institutional traders as a way for retail traders to kind of piggyback on the ideas of the biggest and best traders in the world. And that's exactly what we're going to talk about today. Kind of go through this in a couple of different parts. First, we're going to talk about unusual options activity and institutional order flow as a general concept, defining what it is and why we actually care about it. Then we're going to go over a couple of examples of trades that we've highlighted and flagged this month using institutional equity options order flow. And then we're going to go through, finally, a trading plan, a step-by-step plan for analyzing big institutional equity options orders and determining whether or not those orders represent an actionable trading idea or setup for a retail trader like myself or like you guys. So with that, we'll go ahead and jump on into the presentation here. Before we do, I am going to read our standard boilerplate risk disclaimer. Day trading, short-term trading, options trading, and futures trading are extremely risky undertakings. They are generally not appropriate for someone with limited capital, little or no trading experience, and or a low tolerance for risk. Never execute a trade unless you can afford to and are prepared to lose your entire investment. No trades are recommendations or advice, and we cannot be sued for losses of capital. All trades are for educational purposes only. Please contact your broker or registered investment advisor for execution, margin, and capital requirement questions. Everyone watching this presentation adheres to all disclaimers on optionhacker.com and alphashark.com. Okay, so you guys were going to hear from our CEO and founder today, Andrew Keene, but unfortunately he had a personal matter come up at the last second, but I'm filling in for him. I want to tell you guys a little bit about myself, just so you know that you're in good hands. My name is James Ramelli. I'm a trader and moderator of our live trading room here at AlphaShark Trading. I'm also our director of operations, actively trading equities and equity options on a daily basis, and I regularly contribute to CNBC, Bloomberg, Fox Business, BNN Canada. I also do a fair amount of writing, so if you haven't seen me on TV in the past, maybe you've read something I've written, maybe you haven't, but what I go on TV and what I write about, the things that they ask me to discuss is institutional order flow and what big equity options traders are saying about specific stocks or the broader market at any given time. Okay, so the whole goal of following unusual options activity is to solve this problem that faces retail traders. And I know that this statistic seems really high, and I've actually read recently that maybe it isn't quite this severe anymore, as traders have become more savvy and the technology available to retail traders is a little bit more advanced. More retail traders are making money than they used to, but the vast majority of them lose money in the long run. 8 or 9 out of 10 retail traders who are actively trading are not going to be successful in the long run. But most institutional traders make money trading. Why does that happen? Most retail traders, if they're actively trading, what we would consider an active trader, their account isn't really going to last more than about 18 months on average. That's for the traders that come in, try to give this a shot, don't really have any kind of guidance or understand what it is that they're doing. After 18 months, they've either blown out their account or have lost so much that they just give up and close their account out. So our trading plan is designed and meant to help retail traders get out of this 90% and trade more like institutional traders. It's a lot easier said than done. We're going to talk about some of the advantages that institutional traders have that make it very difficult for retail traders to compete against them. But this is where unusual options activity comes in. It really and truly is one of the best ways for retail traders to trade like an institutional trader and use the advantages that they have inherently and that the system kind of gives them to our advantage. Okay. So trading unusual options activity is all about seeing what the biggest traders in the world trade, right? We have a couple of guys on the slide here that I'm sure you guys have seen before and know. And while we know that these three individuals here are not always right, they don't make money every single year, but in the long run have built up really, really substantial wealth from trading and investing. And we have to ask ourselves, what is different about them compared to the rest of the retail trading public? Do you guys think that the reason that they, like if you had to boil it down to a couple of characteristics that they had in common or things about the way that they approach things that make them just inherently more successful than retail traders, what could we boil those characteristics down? Carl Icahn, Bill Ackman, and David Einhorn. Is it really that, basically the question is this, is it really just that they're that much smarter than everybody else? Is that why they're so successful? Because they're that much more intelligent and have a much more solid understanding of the way the market works and the dynamics behind moves in momentum in the market? Yeah, exactly. For sure that helped them, for sure the discipline that they have and their understanding and knowledge of the market helped them get to where they are now. But at this point, the advantages that they have are inherent related to the amount of capital that they have, the connections that they have. Basically, the answer that I was looking for, yeah, was well capitalized and well connected, right? That is what kind of drives their success now. And I'm not saying that all of these guys are, using insider information or violating SEC regulations, but in general, institutional traders have benefits and advantages that we can't really compete with, and it has nothing to do with how much more knowledgeable they are or how much more skilled they are, right? And this is where unusual options activity enters into the mix. And we care about unusual options activity because it's really the only way that we can leverage their advantages in our favor. They have better access to these four things would be the main drivers of their advantages. But really, when we think about it, it really is, oops, sorry about that. It really is capital that drives most of their advantage over us, right? I can ask you guys how much money you trade with in your trading account. It might be a lot, right? We have customers that have trading accounts that are over $1 million, and they are swinging $10,000 to $20,000 a day in P&L wise, and that's really impressive for a retail trader. But it doesn't even come close to what a big hedge fund or even a small hedge fund will have in their capital reserves and the ability to deploy at any given time. This large amount of capital, right? It's kind of a weird way to think about it, but the more money that you have, the easier it is to get more, and the more you can leverage that capital into positions where you're allowed to control an enormous amount of risk with a smaller amount of capital. And of course, that leverage, if used properly, gives them advantages that we can't really have. But the main point is that this capital drives their advantages in these other areas. So let me ask you guys a question. We'll start here with information. How many of you guys think that institutional traders, as a general rule, never, ever, ever, ever use insider information that they're not supposed to be trading on to make trading decisions? Is it something that never, ever happens? Is it something that happens pretty often? Is it something that, we... I love to ask that question because the answers are always the same, right? Yeah, I gave this presentation last week, right? And I asked the same question, and I heard probably the best answer I ever have to that question. The question is, how often do they use insider information? And someone said, probably as often as they can, right? Pretty darn often as they can, where they think they're not going to get caught. And after watching unusual options activity, if you don't believe that, watch the tape for 1 week, and you will be absolutely shocked at how often large blocks of calls or puts are bought minutes or even seconds ahead of a new headline or announcement or halt in the underlying stock, and then, minutes later, this trader is looking at an enormous profit, hundreds of thousands or millions of dollars. And it becomes pretty obvious that they knew something or knew that this announcement was going to happen before it was actually made public, right? I'm shocked that we don't see someone doing a perp walk on CNBC every single day for insider trading. And there's a lot of reasons why, they don't get caught. If they're sly about it, they can set up positions that will make it look like they had a different market view or were playing volatility or something like that. But it happens pretty often, right? It happens pretty darn often. But yeah, exactly. Exactly. It happens pretty darn often. But let's assume for just 1 second that it doesn't happen that often. That they only use the information that's available to the rest of us in the public sphere of information to make their trading decisions. We know that's not true. We all just agreed that that's not true. But let's assume that it is. Do I still care about where they're putting their risk capital if I know that they're just trading with information that the rest of us has? And the answer is absolutely, right? One, because the size of these funds, they can create some momentum that I might want to try and follow. But I also know that the information that they do get, I don't want to say legally, but the information they do get that isn't insider information goes through a much more thorough analysis process than I can hope to compete with. How many hours a week do you guys spend outside of market hours looking at charts, coming to presentations like this, looking at financial statements, listening to earnings calls, reading articles about names that you're trading or are invested in, reading things up on strategy, doing anything that you would consider quote unquote homework? Yeah, we all spend quite a bit of time doing that, right? And it's commendable for those of you that are spending, some people tell me they spend 30 to 40 hours a week, 50 hours a week outside of market hours doing that type of quote unquote homework. And that's great. Really, really great. They're better traders for it. They have edge over others that don't spend that much time. But being one person, you're never going to be able to compete with the amount of analysis that a team of PhDs from MIT are doing at a hedge fund, right? They have massive, massive access to technology and manpower. So we also know that the publicly available information is, vetted and analyzed at a higher level than I can hope to compete with because I'm just one person. So add back in the notion that, yeah, sometimes they just get a tip from their buddy at the country club over the weekend. It can be kind of bleak. How do we really compete? Yeah, exactly. How can we really compete with this hedge fund institutional trader machine, right? One, we don't want the insider information. I don't want to have information that is material to the price of the stock and non-public. I can't do anything with that. It would be breaking the law if I did. But they do it all of the time. So how do I compete with that? Well, the answer lies in unusual options activity, because at the end of the day, the end result of all of the information, be it insider or public information that comes into this hedge fund machine is a trade. They go into the market and trade, right? If they had some type of an opinion or, some type of piece of insider information, they're not going to not trade on it. That's their whole business. The only reason they exist is to make trades and generate abnormal profits for their customers or for their principals. So if I can get this, the end result, the actual trade that they're doing in the open market, then I know that I don't have to have these advantages, right? Because I get the end result, which is a trade. So this is where we enter into unusual options activity and why we care about it so much. Unusual options activity is driven by institutional order flow, and it's pretty easily defined. I know you're not supposed to use the word in the definition, but simply defined, unusual options activity is any options activity that is unusual, meaning large or a large amount of risk relative to the average volume in the options market for that specific stock. Pretty simple to define. If a stock trades 1,000 options a day, and today someone comes in and buys 5,000 out of the money calls, that's unusual options activity. That's 5 times the average daily volume in that particular stock in one shot, in one big block trade that they came in and lifted calls out of the market for. That shows us that some institutional trader out there, because the order is so large and because it's so unusual, that some institutional trader out there has an idea on this underlying stock that they're coming in to risk a large amount of capital in. It lets a retail trader like me or you guys see where quote unquote smart money is going, where hedge funds are putting their risk capital on any given day. And that's really, really useful because I can see where the big players in the market are, pressing their longs on a day the market is up a bunch, or looking for short opportunities in the day the market is down a bunch, where they're looking for continuation. Someone says, is there a way to set alerts for those kinds of big block options? Yes, absolutely. There's a lot of different trading platforms that offer it, and we'll talk a little bit at the end about the tools that we use. But if you have Thinkorswim or TradeStation, and I believe there are some other third-party applications as well, we offer one. There's option scanning functions in those that you can look for unusual options activity with. We use a scanner that we developed, and I'll show it to you a little bit later on. But there's a lot of places to get this information, and I'm actually glad that you asked the question in that format. You said, are there ways to set alerts for these kinds of big block options or stocks? People and someone always asks, why can't we look at order flow in the stock market to get this same kind of information? And that has to do with the idea of dark pools. How many of you here don't know what a dark pool is, or maybe have heard of the term dark pool but have no idea what it actually means? I'm sure there's some of you. I'll just explain it anyway. So a dark pool is a center of liquidity off of the exchange. Okay, just like, let's say, here's a good example. Lance, let's say that you and I are standing on the street corner and strike up a conversation, and you decide that you want to buy my car from me. Well, I can sell that to you. We can some money or a check or whatever, and I can give you the keys, and that's it, right? It's my property. I can sell it to you for $1 or for whatever I want. The same thing goes for stock. If I own a share of stock, that's mine. It's my asset. I can do what I want with it. I don't have to sell it on the exchange. I can sell it to you right now. If we were standing at a barbecue in someone's backyard, I could say, hey, Lance, you want to buy this share of Apple stock from me for $132? And you can say yes, and we can make that transaction. So big institutions know that if they have enormous blocks of stock that they need to trade with each other or want to trade, that going to the NYSE or the NASDAQ or any exchange to try and get filled on, say, 1 million shares of Apple is going to be pretty tough. Let's say I have 1 million shares of Apple to sell. I know that I probably can't sell all 1 million shares in one shot at one price without moving the market. So what other option do I have to me? Well, I can go to a dark pool. Big banks run these. It's a center of liquidity off of the exchange. I can put my offer out there for this 1 million shares of Apple. Let's say your hedge fund says, you know what, I want to buy 1 million shares of Apple. Good. We're going to go ahead and make this trade with each other. So 1 million shares of stock transact at one price, and this 1 million shares that were involved in this transaction is not going to be reflected in the volume that we see at the end of the day on the board, right? So what that means is that when we're looking at the buying and selling in equities that happens during the day, it isn't really representative of all of the volume that's taking place. I read an article sometime back that said Citadel, which is down the street here in Chicago, one of the bigger dark pool operators, that by 10 o'clock in the morning, they've already traded more stock in their dark pool amongst their clients than the NYSE is going to trade all day. So it doesn't really work as much for stock. I can't really look at order flow in actual shares of stock and get a good idea of where institutional money is actually putting their risk, because I know that so much of this volume has taken place someplace else that I can't see. For options, there are no dark pools. So anytime they come up with this idea that they want to trade in the options market, I'm going to be able to see it. So this is why we focus our energy on trading equity options and following order flow in this equity options market. Let's go through really quickly kind of the process for a big institutional trade being put on, and I think it'll be even more clear. So there's no dark pools and options, like we said. An institution's going to come up with a trading idea. This idea is based on, the analysis they've done, or, the tip that they got from their friend who's a VP at Kate Spade or something, right? Like, they're going to go out there and try to get this order filled. Let's say they want to buy 10,000 out of the money calls. They call their broker. The broker shops the order around to market makers off the floor. If they don't want it, maybe then they send the order to the floor. If it doesn't get filled on the floor, then maybe the broker says, okay, we'll fill it for you. We'll hedge it ourselves and deal with the risk afterwards. Thank you for being a good customer. The thing you got to realize is that regardless of where it's filled here, either by a big options desk on the trading floor or by the broker, they don't have the ability to fill this order in a dark pool. So regardless of who takes the trade, it happens on a public exchange. So it goes through, the CBOE, the NYSE, the Philadelphia Exchange, the box. Doesn't really matter where it's filled. As soon as the order is cut on one of these exchanges, all of the pertinent information around that trade is now public information. And the traders that are on either side of it don't really have a way to hide it from the rest of us like they would if they were trading stock in a dark pool. Okay. So on the very next slide, we're going to go over an example of what this actually looks like. But before I do that, is everyone clear on the discussion we just had on dark pools and why this works for options but not something like equities, not the underlying equity? Are we all clear on that? Does anyone have any questions thus far? And I should have said this right at the very beginning. If you guys do have questions, please interrupt me. don't let me continue to talk if you're not sure on something, because as soon as one person has a question, I guarantee there's at least a few other people that have the same question. Okay. Someone says, will DPs affect price? What do you mean by DPs, Lance? Right, we're going to get to that in the actual trading plan. That's I'm really glad you brought that up, because the main participants in an equity options market are the hedgers and the speculators, and we're going to talk about how will dark pools affect the price of the stock, like stock on the open market? So they're typically trading like pretty darn close to each other, because if they weren't, then there's an arbitrage opportunity, right? Like if shares of Foot Locker are trading 69.30 on the NYSE, they're going to be pretty darn close to that in all these dark pools, because if they weren't, then there's an arbitrage opportunity. Someone can pick it up on one exchange and sell it on the dark pool, or vice versa, and capture that spread, right? The fact that that is something that can happen keeps them pretty close to each other, because as soon as there's a discrepancy, it's arbitrage away, right? Does that make sense? Okay. So this is what unusual options activity actually looks like, and this is an order that hit the tape earlier this month. Pretty much the second day back into the new year. A trader came in and bought a big block of the Jan 13th weekly expiration ARIA 13 strike calls for 40 cents. Now, don't get too hung up on the format of what you see here. This is what it looks like in our scanner, but those scanners available in options, Thinkorswim and TradeStation, it's going to give you the same information, because the exchange has to report all of this info relative to the order that took place, right? So the format is just what it looks like in our scanner. All the same data is in all of those other places that you would be able to get this information from. But there's a lot of information that we can get and then glean off of this order. We can see whether it was bought or sold, the size of the trade, the stock that it traded in, the expiry and the strike price, whether it was a call or put, the price it traded at, whether it was an opening or closing position, where the stock was trading when the order took place, and we can also see the market at the time of the trade. And this is how we figure out whether it was a buy or a sell. I saw someone asking that a little bit earlier. So the market was 30 cents at 40 cents at the time of this trade. This is the market maker's bid and offer. The option traded at 40 cents. They didn't try to work an order in between the bid and offer. They just lifted the market maker's offer. So because of that, we know that this was bought. What else can we see here? That the fact that they lifted the offer rather than trying to get filled mid-market also tells us that this was a pretty aggressive trade, right? They didn't want to try and get this for a discount. They wanted the position and wanted the market maker to give them all of the size now, so they just lifted the offer, right? It's also a pretty aggressive trade. This happened on 1/4, and the expiration of the options was Jan 13th, right? And the fact that we flagged this, the reason that we did was because it was a very large trade for short dated options in ARIA. It doesn't really trade options in this size very often. Well, it becomes a pretty obvious why they did this in the following days. 3 days later, an announcement is made in ARIA, some type of activist action. I don't actually remember exactly what the headline was, but the stock gaps over 70% of the upside on Monday, the following weekend, or after the weekend. On Monday morning, we're looking at the options trading at $10.81. Trader made $1.75 million in a couple of days. If I would have bought a 20 lot of these, I would have made $20,820 on essentially $800 worth of risk, right? So I can ask you guys a question here. I probably already know what your answer is going to be. In this particular situation behind the Ariad Pharmaceutical weekly call buying, just got lucky, or did they know that this was going to happen? And I think the actual reason behind the stock popping was they had some positive drug trial results. Yeah, right. I mean, does anyone think that, yeah, he knew that this was going to happen? And think about catalyst events in equity. Some stocks don't really have catalyst events all that often outside of their quarterly earnings report. But stocks like ARIA, biotechs, stocks that have, really important new product launches or, legal situations, those have catalyst events where we can see moves like this. It's pretty obvious looking at this chart that this guy knew what was going to happen in ARIA, right? A few days later, stock gaps to the upside. I don't know about you guys, but I haven't seen anything on CNBC or Bloomberg or Forbes or MarketWatch about someone getting busted for insider trading in ARIA. Odds are they're not going to be. I haven't seen anything about this. I don't know if you guys have, right? And this is a good example of this type of unusual options activity ahead of something that catalyzes the stock and gives it this humongous type of move. I don't want you to think that this is typical, but it definitely happens a lot. Someone says part of an option value is price is stock price, not the other way around. I'm sorry. Is there a if the option goes up, does the equity go up as well? Yeah, that works the other way around. Sorry, I understand what you're saying now, but I will talk about the relationship between unusual option activity and the stock price as well, because that is something that's interesting. We're going to talk about that in a little bit, though. So some trades set up better for swing trades. Some trades set up better for day trades. How many of you here would consider yourselves strictly a day trader or strictly a swing trader? Probably not too many of you. Most of you probably would say that you're a blend of both, right? Some of you might not like to carry risk overnight. Some of you might not like to sit in front of the computer all day and try and day trade positions and manage risk. What's nice about trading unusual options activity is that it really works well for any trader, no matter how they define themselves. And the reason for that is because institutional traders do it all, right? They come in and put on options positions that speculate on movement in the stock over the next couple of months, even years. They come in and they put on positions that speculate over the next couple of days. They come in and put on positions that speculate over a very short period of time. If you watch the tape tomorrow, you'd be surprised at how many institutional traders are coming in and buying calls and puts that expire at the end of the day right on the open because they think that there's some momentum behind a name or we're going to get a big intraday move in something. It happens all the time. All the time. So all I need to do is pay attention to the order flow that's relevant to me and my risk tolerances. If I don't like to day trade, well then guess what? I'm not going to pay attention to the options that are hitting and expiring in August. If I don't like to swing trade, well then guess what? I'm going to be focusing on the orders that are hitting and expiring at the end of the week or maybe the next week out. So it's really just about what you want to pay attention to. People ask me all the time, who is this really for? What type of trader does best here? And I think that any trader can learn to identify the order flow that's most relevant to the style that they are already kind of employing on a daily basis. So we're going to talk about some of the differences between day trade and swing trade setups as well. Here's a good day trade example that hit earlier this month in Triple D. This is a name that tends to see rather interesting, unusual options activity because it's one that's very closely followed by hedge funds, and it moves pretty well, right? It's not a small, range-bound, tightly trading stock. It tends to see some nice movement. So here we saw an order that we flagged. It was the same week of Jan expiry. They came in and bought 1,000 lot of the Jan 14 half calls for 43 cents when the market was 36 at 43. Remember what we said a little bit ago? If they're lifting the offer, not trying to work something mid-market, it's a pretty darn aggressive trade. It also happened to hit 2 seconds after the opening bell. This is our favorite type of trade setup. High risk, high reward. And high risk only in the fact that, if the stock moves the other way when trading at 1440, these things can go from 43 cents to like 15 cents pretty darn quickly. But because I know that they can't be worth less than zero, I can get into this trade with a level of risk that's comfortable for me, knowing that if they go to zero, I have a defined loss. But I also know that if the stock gets a bid, that these have so much gamma and a lot of deltas as well because they're at the money that I can see these go from 43 cents to 80 cents like that as well. Okay, so something else to note about this is the timing. Very interesting. Order hits at 9:30 and 2 seconds. So the order hit 2 seconds after the open of the market. Let me ask you guys this. Unless you were prepared to do so, could you make a decision on putting on a position within 2 seconds of the bell ringing? Or would you have had to be sitting there with your finger on the mouse ready to put the trade on? Right? Pretty hard to come up with this idea and execute a trade 2 seconds after the opening bell. This trader put this trade on and they were waiting for the market to open and tried to get a fill as soon as they possibly could, right? That's why it happened so early. The reason why they were so aggressive to get in right when the market opened becomes apparent a little bit later. Stock has a just absolute rip roar bid to the upside from the moment that they bought these calls until the end of the day. Just a huge move, right? Stock breaks the Ichimoku cloud to the upside on the 5-minute bar as soon as they buy these calls. And by 2 p.m., the calls are already trading $2.40. This trader made 200 grand in a couple of hours. They actually traded a little bit higher than that by the end of the day. So this is a really good example of the type of order flow that a day trader would be looking for. Really short-dated, aggressive options with a lot of gamma, meaning the trader is taking on a lot of risk. And they're taking on a lot of risk in the fact that they can see these go to zero pretty quickly, but they're being so aggressive that it really looks like they're looking for an upside move. Someone asked me a little bit earlier, how do we know that they're not buying these calls, say, to hedge a short stock position? Well, that's where technical analysis comes in, right? And just kind of some thinking about how the order is coming across. If a trader was looking to hedge a short stock position because they were worried about the market moving higher, would they be more likely to pay 43 cents to hedge that risk for a couple of days, or would they go out and buy something a little bit longer dated? If there was no catalyst like earnings, it's just a normal day in Triple D, why would they come in and hedge with something that short dated? They probably wouldn't. So that right off the bat makes it more likely to be a speculative order. Second, we can see that the momentum in the stock on the open was really darn strong. The 5-minute bar was breaking the cloud to the upside. If we looked at how it traded the day before this, it was trading pretty strongly. It isn't too often that you see institutional traders come in and step in front of strong momentum. We'll go over that in a second, but that's the indicator that we have here on this chart. Right, so if we're technically looking like we're setting up for a breakout and the momentum is strong into the upside, it's not super likely that a trader is coming in and selling stock into that momentum and then buying upside calls to protect himself. We're going to talk about a couple of other things that I can do to make that determination on, say, a swing trade time frame as well. But at the same time, the analysis of the cloud and also just kind of thinking about the order is what helps me make that determination. Okay. So Andrew, our head trader, actually day traded these options and was able to take profit targets. In that day, he made $910 on, I think, like a 15 lot of these options. I mean, just fantastic, fantastic profits that he was led into by this unusual options activity. in Triple D. So another good example from this month was in YPF. If you guys have been paying attention to this stock, odds are you probably haven't been, because it's not really that interesting or closely followed of a name, but that's what makes the order flow in it even more suspicious. The trader came in about 1,100 of the Feb 18 calls for 55 cents when the market was 50 at 55. Hit a little bit later on in the morning, but the stock was breaking the cloud of the upside on the daily bar. So since we're able to confirm this as a stock that's showing bullish momentum, we're ruling out the notion that this is a trader buying these calls against and putting this on, probably to speculate on upside in YPF. The next day, the stock gapped to the upside, and it's actually continued higher since then. If we take a look at where YPF is trading today, it's actually well above the levels it was trading at through this couple of day movement. It's trading 22.16 today. Actually traded as high as 22.79. So really, really nice. We were breaking the Ichimoku cloud to the upside and had a really bullish bar right here. Stock had been just rip-roaring to the upside. Again, these things have already traded as high as $4.50 and still have plenty of time left. This trader at the highs was up over $436,000 in this position. Okay, so those examples hopefully have made it pretty apparent why we care about unusual options activity. Hedge funds and big traders have more information than us. Whether it's information like ARIA is about to get a really good drug approval and the stock's going to be up a ton in 2 days, or if it's information like, hey, there seems to be some massive momentum behind Triple D, we think there's going to be a very, very aggressive move to the upside on a short time frame. We're going to capitalize on that with leveraged options with a lot of gamma. It's good information to have. Knowing where they're putting their risk is never going to be something that hurts my trading strategy. I say this all the time. Even if you're someone who trades equities and has never traded an options contract in your life, about what institutional money is doing with their risk capital by following unusual options activity. And what's nice about it is that, and someone always asks this question, so I always just kind of get ahead of it. People say, hey, if you buy those ARIA calls that institutional trader bought because he knew that there was going to be some kind of announcement, could you get in trouble for insider trading? And the answer is absolutely not. We're using the order flow and gleaning information off of that to then make our trading decisions. Okay. If they know something, it doesn't really matter to me. I don't care why they know or how they knew. All that I care about is the order flow that they generate and being able to pick it up and determine that it's an actionable trade setup off of the tape during the day. Okay. So we're going to jump into the trading plan part of the presentation now. Before I get into that, does anyone have any questions about anything we just talked about? This part's only going to take about 10 or 15 minutes or so, and then I'll leave 5 or 10 minutes at the end for a broader Q&A session, but I want to make sure that we're all on the same page before we jump into the actual mechanics of the trading plan here. How often do these trades happen? Every single day. Every single day. You know, the options go from 40 cents to $10, but it happens on a daily basis. We see unusual options activity hitting the tape, and we see opportunities for traders to profit on this type of momentum that institutional money creates, right? Because when we talk about the day trade orders as well, when someone buys an aggressive amount of short-dated options, it increases the implied volatility in that line of options. The demand for options is going up, and traders can profit off of that bump in implied vol by itself without any movement in the underlying stock. So a lot of different ways to make money by following unusual options activity. I mean, I just showed you 3 examples that have all happened within the last, 3 weeks. And those are just 3 examples. There's another one on the next slide here that happened yesterday and worked out really well today. I mean, I can probably find 30 or 40 from the last 3 or 4 weeks that I could have used in the presentation. So all of this is well and good. We see that some of these orders have the potential to net fantastic outsized profits, but it's not as easy as just buying every single, yeah, we do, Steve. it's not as easy as just buying every single line of options that is trading at a multiple of its average daily volume. That is actually a surefire way to lose money in the long run. So we have to have a trading plan in place that helps us filter out the hedges, focus on the speculative bets, and also get on the right side of probability. We want to find the setups that have the best chance of working out. And we want to avoid all of the hedging activity that we're seeing from institutional money. Think about that logically. If they think that, you know, they're buying options as a protection against their underlying position, well, then they don't actually think those options are going to work out. They would actually prefer for them to go to zero. So what we've done is developed a trading plan. It's a step-by-step checklist to take orders that we're seeing that would fall into this category of being unusually large, and then doing further analysis to determine if the fact that they are unusually large is enough for us to get into a trade and mimic the position that institutional money is putting on. So we call this trading plan the OCRRBTT trading plan, and I know that's not the most eloquent name out there, but it is easy to remember, and it tells us very simply what we should be looking at and considering when we are analyzing and evaluating unusual options activity. It stands for Open Interest Chart, Risk Reward, Break-Even Time, and Target. Okay, so we're going to run through a trade that actually hit the tape yesterday. This is the Foot Locker March. March is actually relatively short dated, right? We're in February right now. This isn't a really aggressive, long dated position, but this is an unusually large bet in Foot Locker. Foot Locker doesn't really trade this much stock or this many options in a day all that often. Trader came in and bought 3,000 of the March 70 calls for $1.74 with at 11:30 in the morning Eastern time, with stock trading at 67.75. Open interest was 128 contracts. The first thing I need to determine when I see an order hitting the tape is whether or not it's opening or closing. Because if it's a closing position, I don't want to be getting into it. Just because someone's buying options doesn't mean they're putting on new risk. They could have been short those options and are buying them back now to close them. But there's one way to tell for sure with certainty that a position is opening, and that's by comparing volume and open interest. Think about that logically. If the open interest was only 128 contracts and they're coming in now and buying 3,000, well, there isn't 3,000 here for them to close. So this has to be opening. So if volume is less than open interest, there's a chance that the trade is a closing position. And then I don't need to look at anything else. I know I don't want to trade it. If I'm really looking to filter out and be selective, I also want to see the orders that have the biggest volume over open interest. What do you think is a more significant trade? If someone comes in and buys 5,000 contracts against 0 contracts in open interest, or if someone comes in and buys 15,000 contracts against, say, 9,000 contracts in open interest. Which of these two trades is more significant? Which one would I care more about? The larger order or the one that's larger relative to the open interest in the line? Would care more about this order? Yeah, always. Because I know that in this one, there's already 9,000 opinions about this option. 15,000 is 3 times as big as the size of this one, but there's already open interest in this. Someone is coming in here and saying, you know what? There's no open interest here. This is super noticeable. We're coming in and putting this order on. This is the one that I always care about the most. So that relationship between volume and open interest is important. It helps me determine whether or not the trade is opening and also which trades are kind of more significant, right? Yeah, exactly. I mean, someone might, the trader that's putting on that huge order into 9,000 contracts in open interest, they might have already put a trade on that's down. They might be adding to a losing position. They might also be taking the other side of whoever put those on in the first place. It's not as significant as the first order that we talked about there. So after that, I do a quick analysis of the chart, and the Ichimoku cloud helps me do this. If you're not familiar with the Ichimoku cloud, it's actually one of the simplest indicators to use. Looking at the daily bar here, we see the shaded area, this shaded kind of area that we have on the chart. It's pretty simple. Anything trading above the shaded area is in bullish territory. Anything below it is in bearish territory. So if I see calls being bought in a stock, I want it to be trading above the cloud. This was actually breaking above the cloud when they put those on in YPF. If I see puts being bought, I want the stock below the cloud because I want downward momentum. So I want the momentum on the chart to agree with the position that the institutional trader is taking. If it doesn't, then it's more likely to be a hedge, and I don't want to take the trade. Okay? So it's really quite that simple. We use the Ichimoku Cloud. You can use whatever technical analysis methods you like. If you're use types of momentum indicators, that's fine. All you need to do is confirm technically the setup that the institutional trader is taking in the options and lining up the proper time frames. If they're trading weekly options that expire tomorrow, well, I'm not going to do my technical analysis on the daily bar, right? I'm going to do it on something shorter time frame because the trend that they're looking to play is only the trend from today into tomorrow, not from today into 3 weeks from now. Okay. So after that, I'm going to look at risk, reward, and break even. And what I want to do is determine if this is a trade that I can take and still be inside of my risk parameters. You can figure this out as a percentage of your book or as a total dollar amount, but I always ask myself, can I take at least a 4 lot of these options and stay inside of my risk parameters? For me, I don't want more than 5% of my book in any one position based on unusual options activity. And the reason I need to figure out whether or not I can take at least a 4 lot is because I want to be able to manage my risk as the trade goes in my favor. If I buy options for $1, what is my risk? What is my maximum risk in that position? It's $1, right? The most I can lose is $1. They can't go below 0. Well, let's say that, I put this trade on and I come in tomorrow and the options are worth $1.25. What is my risk now? Well, now it's $1.25. My risk has increased. So what I do is I put on a position that I can scale out of. So as this thing moves in my favor and continues to gain value, I can sell portions of the position, lowering my overall risk while still locking in profits. It's just a better way to trade unusual options activity. So the only person that this is really kind of important for is someone who has, say, like $10,000 in their account. If they see an option hitting the tape that's trading at $2, can they take a 4 lot and stay inside that 5% risk parameter? No. So they wouldn't really be able to take the trade. Stop losses are tough to use in the options market because in general, you can't really rely on them. Stocks can gap and all of a sudden trading well below the stop loss that you had in place and you've lost way more money than you thought you could. Happens all the time. Ask anyone who was long calls in Under Armour this week ahead of earnings, right? So after that, it's all about time and target. If we're taking a trade, we want to take the same time frame as the institutional trader, right? We don't want to try and mess with that. We just spent a whole hour talking about how they have better information than I do. They have insider information in some cases. Why would I ever want to see this order hitting the tape in Foot Locker and take a completely different position? I want to take the same trade that they do because they spent figuring out what the most efficient and effective way was for them to express their view about the market. By the way, if you take a look at Foot Locker today, the March 70 calls that they bought for $1.74 yesterday closed today $235 at $265. So the stock got a really nice bid today, and you can see here's all the open interest from their trade yesterday. $235 at $265, really, really profitable trade for anyone who got into their position yesterday, right? So this is why we pay attention to this. Another really good example, and I actually took this trade yesterday, was in USG. Trader came in right at the end of the day, bought 1,800 of the March 32 calls for 90 cents ahead of earnings. I actually got into these for 85 cents. And, I actually got into these for 85 cents. And then by the end of the day, or by today, I was taking off profit targets at $1.15, right? So really good example of how this stuff happens all the time. I wanted to show you guys 2 more examples of things from this week to illustrate just how often these types of alerts and orders come across the tape. Okay, so I want to leave some time here for questions, but before I do, I want to talk to you guys about how you can learn a little bit more about trading unusual options activity and how you can get some real-time UOA related trade alerts from us, we have a special offer for those of you that are here in the CTU presentation, and you can get it at this link here, alphashark.com/our-option-alerts. And what it comes with is a workshop that is about 3 hours long on trading unusual options activity and reading the tape, and a much more in-depth explanation of all the minutia to the trading plan that I just went over. That was kind of like the OCRRBTT trading plan light. We talk about how to read options volume versus open interest and teach you how stock volume is important when trading unusual options activity and how you can actually use the stock to take advantage of UOA signals. We also offer with this as a special bonus for those of you that are here, 1 month of our real-time trade alert services based on unusual option activity. So this is a real-time SMS text alert service that gives you access to Andrew's entries and exits during the day as he's taking them. So as soon as he puts on a trade, you're sent a text message with all of the relevant details around it, where he got in, where he's planning to get out, and the stop losses he might be using. And we're going to give you guys 1 week to watch Andrew trade live in our trading room. So you can watch him trade the open every day. You can see the unusual options activity scanner that we use and spend a whole week watching someone analyze this order flow and learning how to analyze it yourself along the way. Will we be at the Money Show next week? No, actually, we won't be at the Money Show. We got too much going on here to make it out there for that. We actually were at the one in Vegas. We had a booth at the show in Vegas, and that was a really, really good time. Got to talk to a lot of really cool people about this concept and trading unusual options activity. So we had a good time there, but we're not going to be making it out for Orlando. But the link is right here, alphashark.com/our-option-alerts. It's only $49 to check it out. It's a fantastic value. If you go to our website, the workshop itself is $499, and our alert service is $150 a month. So you get quite a bit of value here for this particular offer. So if you found anything that I just said throughout this past hour interesting, I highly encourage you to check it out, because this is a really good hands-on way to learn a little bit more about trading unusual options activity. Alrighty, guys, so any questions, any other questions either about the presentation that I just gave or the offer that we have here for you guys? Any other questions? I want to open it up now for some broader Q&A time. Got a few minutes left here. So any other questions, guys? Any other questions? You guys were a great audience. I really like presenting to people that actually have questions throughout the presentation. So thank you for that. Any other questions, guys? Yeah, they're big unusual options activity buffs. They definitely focus on UOA. The orders that we flag, they oftentimes will highlight later on fast money. So like this morning, this is a really good example. This morning we flagged Restoration Hardware, these March 27 calls that they bought for $2. The stock ripped after they bought these, and then lo and behold, at noon, right around lunchtime on Fast Money, they're like, "Hey, did we're highlighting these Restoration Hardware calls." So we happen to catch it, I think, a little bit quicker than they do sometimes, but it is a somewhat similar approach. Great, thanks, Dan. I hope you workshop sent to you right away. It's an on-demand workshop, so you can start going through it right away, and then you can come into the room to watch all this live trading as well, starting on, I think the week starts Monday, actually. So you get the weekend, you get tonight, and then tomorrow and through the weekend to go through all of the educational materials, and then you're able to come into the room and check it out live on Monday. No, you don't need to buy any software. I actually wanted to show you that in if you have Thinkorswim, and I don't have my TradeStation account up and running here right now, so I won't show you there, but I'll show you in Thinkorswim. They have a function in there called Option Hacker, and it's a scanner that lets you scan the options market with a bunch of different criteria, not just based on unusual volume. A lot of traders use it to find options that are rich or expensive to trade credit spreads with, but we can use it to trade unusual options activity as well. Our scanner is completely standalone. It runs in a web-based platform. So it doesn't matter. It's platform agnostic. You don't need anything specific to run it. But in Thinkorswim, like, they have their own solution for this. If you see this little button right here, it says Sizzle Index. If you press that, it's going to give you all of the unusual option activity for today. The only problem is they use a moving average of volume to get this. So around earnings, and we're in the middle of earnings season right now, it gets really skewed. Like this Sizzle Index, 305 times the average daily options volume. Over the last 5 days, maybe, but we use a much longer comparison. We look at 22 days of average volume because we think that actually gives us an idea of what the average is, and then, of course, what above average is related to that. But what's nice about the Thinkorswim one is that you can really do a granular search. There's a lot of options here. So, like, for example, I can say, don't show me anything that is below 4 times the average daily volume. I want it to trade at least 500,000 shares a day, and please don't show me any penny stocks. Give me something $15 or above. Then, there's like 3,000 stocks here that qualify. Now it's a much smaller list, and I can get more and more granular there as well. Someone says, how often do you win versus lose following unusual options activity? So that's not even a metric that we bother to track. For this particular type of strategy, I don't think that win rate is really all that important because, for example, let's say I wanted to look at that win rate, and I can very easily give you a strategy right now that'll make money 90% of the time. Super simple. In any stock, name the stock, and I'll give you a strategy that makes money 90% of the time, as long as the stock has options. But the one time that blow out all the losses, all the winnings, and then some from the 9 times that it did, right? So what we always say is, if I took 5 trades, all options that were $1, 4 of them go to 0, but the 5th one goes to $6. Did my win rate really reflect my success overall? No, it didn't, right? Yeah, selling far out of the money options would be how I would make a 90% win rate that would blow out my account the time that I get it wrong, right? So win rate's really not all that important. What we say is that having an understanding of unusual options activity and being able to track this order flow gives any trader a leg up or an advantage in whatever strategy they're already running, right? Because it gives you good information. For example, today we saw a lot of activity in Yelp, which is a stock that has been just ripping to the upside recently, right? And we actually saw all of this short-dated put buying in Yelp while it was trading near the highs of the day. So this morning in our trading room, we were watching this happen and began to say, if I was long anything in Yelp, I'd start to look to get out on the open, and lo and behold, the stock reversed and went into the red by the end of the day, right? A ton of puts were being bought. So even if I didn't have a position on, and even if I didn't want to trade options, I could look at this order flow, and this is only one of like 6 or 7 big blocks of weekly Yelp puts that were bought. I could look at that and say to myself, "Ooh, I might not want to hold this position anymore. I might want to get out of my long." And that type of information, I think, is incredibly valuable. Alrighty, guys, so any other questions here? I think we're pretty much bumping into the end of the presentation time here. I'll put the link in here again for you guys. I'm still 80% of the time, and it's very difficult to be profitable in the long run. So far this year, Andrew, our head trader, is up money trading unusual options activity. We've had some pretty big wins. Yeah, if you guys have any other questions about this that pop into your head later on, or after we part ways here, I will put my email address in here for you guys as well, so you can reach out to me. I don't always respond instantly. I do typically get back to anyone that emails me within 24 hours, though. So, just let me know if you have any other questions. All right, guys? So I think that will wrap it up for today. Thank you very much to Cyber Trading University for having me here today to talk to you guys. I very much enjoyed presenting. I'd love to talk about unusual options activity, in case you didn't realize that throughout the presentation. So I will go ahead and bid you guys all adieu from here. Thank you all so much for your questions, and for those of you that I can see taking the offer here, I can see several people have already opted in. Link is here. I'll put it in here one more time, just in case you guys need it. AlphaShark.com/ouroptionsalerts. And again, feel free to reach out to me with your questions via email that you come up with a little bit later on, and I'd be happy to answer them. Or just chat about the options market, whatever you want. Alrighty, guys. Thank you all very much. Everyone have a good evening. And as always, happy trading.